Why is the spread between the 10-year note and the 30-year fixed mortgage rate so high compared to what we've historically seen? Right now, we're sitting at about 2.5%, but historically, it's been more like 1.75%. So why is this? One reason is prepayment risk. Investors are worried that because of the fact that rates are so high, and when rates inevitably come down, people are going to refinance their mortgages. They think that the duration on these bonds might be lower than we have historically seen. So they are charging a risk premium for this reason. Another big factor has been Fed policy over the last few years. The Fed has been selling mortgage-backed securities into the marketplace instead of being a buyer of mortgage-backed securities. And the Fed was one of the biggest buyers of mortgage-backed securities in prior years when rates were low. So that has led to supply and demand issues that has also driven yields up. Now, in recent months, we have seen an improvement in the spread between the 30-year and the 10-year. Previously, it was as high as 3%. So the 2.5 spread that we're seeing now is a result of some of the Fed policy statements that they've had, signaling that they may take a more dovish policy here and look at more rate cuts. And they also are less concerned about inflation. Inflation is a huge driver of higher long-term interest rates. And just this week, Jerome Powell was talking about liquidity possibly tightening up and that the Fed may have to stop their policy of running off their balance sheet. I'll be going deeper into this and other housing and mortgage market topics at my next CE class on November 18th at 10 a.m. The details are below so you can grab your spot. Hope to see you there. And as usual, I'm here for you as a resource. Please reach out if you have any questions. Have a great weekend.